Advanced Financial Accounting PowerPoint presentation. In this presentation, we'll talk about consolidation and income taxes. Get ready to account with Advanced Financial Accounting. For a non-taxable acquisition, the tax basis of assets acquired and liabilities assumed is not changed from the acquisition. In this case, then, the carrying basis is the acquiree's basis. The acquiring company needs to identify all assets and liabilities acquired and their fair market value when the acquisition takes place, and then the deferred tax assets or liabilities that are from the difference between the fair market value and the tax basis when allocating the purchase price must be recorded by the acquiring company. So we have the tax expense allocation when consolidated return is filed. What are we going to do with this tax expense allocation? The parent company and subsidiaries can file a consolidated income tax return, or they can choose to file separate returns. So this is one of the things that we're going to have to consider here. We've got a controlling interest that's going to be involved. So we have two entities. One has a controlling interest in the other, obviously parent-subsidiary type of relationship. Question then, should we report just one tax return, or should we have two tax returns? This is going to be a decision that needs to be made. But if we file one tax return, then at least 80% of its stock must be held by the parent company or another company included in the consolidation return for a subsidiary to be eligible to be included in a consolidated tax return. So in other words, if you talk about a consolidated entity, when do we have to make consolidated financial statements, or when should we possibly? When there's a controlling interest. When does that happen? Usually over 51%, because then you have controlling. However, if you're deciding whether or not to file the tax returns as a single entity, one tax return for the multiple entities, or have separate tax returns, you need an interest of 80% in some way, shape, or form in order to file the one tax return. So obviously that's a bit more restrictive. That's going to restrict your options as to whether to file one or two returns. Advantages of filing a consolidated return. So then you might say, well, okay, what if I have the option of the consolidated return for taxes or filing two separate returns? What are the advantages and disadvantages? So we're talking here about the advantages of filing a consolidated return, meaning subsidiary parent putting them together, one return filed. Losses on the company can be offset against profits of another. That's pretty nice. So, right, if you had a subsidiary that had a loss, then possibly you can take that loss then against possibly the parent company because you're filing, the entity as if they are one entity. So dividends and other transfers between affiliate companies are not taxed and could help to avoid limits on the use of some items like foreign tax credits and charitable contributions. In other words, if there's an AGI limitation, adjusted gross income limitation, a phase out of some kind, then having two entities together may provide more eligibility depending on how the phase out works with your income limitations. So limitation on filing a consolidated return. After an election is made to include a subsidiary in the consolidated tax return, the company may no longer file separate returns in the future unless it gets approval from the IRS. So you might think, okay, if I have this situation, maybe I work this thing out as if I file a consolidated return, and then I work it out as if I'm not consolidated, and I do that every year, and then I file the one which is better. But you can't really do that because once you make the jump to the consolidated return, you're locked into that unless you get approval from the IRS, which means you would need a reason because the IRS wants consistency typically. So once you basically go to that step, once you basically make that move, then if you want to unmake it, you got to convince the IRS and get approval to do so. And typically you would think you would need a reason, to make the change back. So the tax year of the subsidiary needs to be brought into conformity with the parent's tax year. So if you had different tax years, in other words, then you would need to obviously pull them into alignment in order to file, the one tax return. It can get very challenging to prepare when there are a lot of companies involved. And you could just imagine the complexities. Obviously, one company is very complex. Can be if you're talking about a large company. If you're talking about multiple companies, especially layers of companies within a single return, that could be difficult to do. Tax expense allocation when a consolidated return is filed. So income tax expense will need to be assigned to the individual companies because only one income tax amount is determined. So obviously, if you put the tax returns together and then you file one tax return, then you're going to be coming up with one income tax expense amount. And then when you think about the financials, how are you going to record that on the financials? You're going to have to then have some method to assign that income tax expense out to the companies that will be involved. Amounts reported in the income statement of the separate companies and the consolidated entity can be affected by the method of tax allocation. So the amounts reported for the income statement and the separate companies and the consolidated entity itself can be affected by this allocation method. If the subsidiary is not 100% owned, tax expense assigned to the subsidiary will reduce proportionately the income assigned to the parent and non-controlling interest. So obviously, if there is not a controlling interest, then when you assign the taxes out to the subsidiaries, which are not fully owned by the parent, but they have over possibly the 80% or they have the controlling interest, then obviously you have to deal with that non-controlling interest, and there's going to be an effect of applying those taxes out to the non-controlling interest as well. Unrealized profits when consolidated return is filed. So now, note, you got this situation, you could have these situations where you got these intercompany basically transfers or transactions that could happen. We talked about the situation where, say, inventory went from one company to another company, and the other company has not yet sold it to a third party. So from a consolidation standpoint, you would think that there would be profit that is on the books of one company that shouldn't be there, and the inventory would be overstated. What do you do on a tax return situation with regards to those kind of situations? So the intercompany transfers will be eliminated when we calculate the consolidated net income and taxable income. So typically, if we're doing the consolidated entity, then we'll eliminate those when we do the consolidation process. So you think about our consolidation worksheet in a similar fashion for the tax preparation. And if you're filing one tax return, one entity, then we would do the similar process in eliminating those intercompany profits. Since profits are taxed in the same period they are recognized for financial reporting purposes, no temporary differences happen and no additional tax accruals are needed in preparing the consolidated financial statements. So that's with a consolidated entity. And you can imagine, obviously, when we think about these worksheets, we already put the worksheets together. We dealt with these intercompany profits already. We basically eliminated them in the intercompany items. What happens, however, if the unrealized profits when the separate returns are filed? So now we have two entities that we say we file a consolidated financials for, and we do our elimination entries. However, when they do their tax returns, they're now going to do their tax returns separately. They're not going to be consolidated together. But when that happens, that means that like one of the returns might have had sales that went to another return, and the other company didn't sell it, right? So you got this kind of profit situation going on between the entities. So what happens with that? Well, companies are taxed individually on profits from intercompany sales. So they're going to be taxed on it individually. They're going to be filed when they file their tax return. No consideration is given to whether their intercompany profits are realized from the consolidated viewpoint. So they're not looking at it from a consolidated viewpoint in this case because it's a separate tax return. So if there was profit then that was realized, or if there was profit that went from one company to another consolidated entity, because we're not looking at it from a consolidated entity standpoint, the consideration isn't given there, and you would think it would increase the taxable income and possibly the tax. Tax expense on the unrealized intercompany profit needs to be removed when the unrealized intercompany profit is eliminated in preparing consolidated financial statements. So now you're going to have a tax expense when you think about the consolidation process now. So now you've got this added expense for the gross income, and that's a result that you're trying to eliminate with the consolidation entry now. So now you're thinking, if we're going back to the consolidation entries, we have two separate tax returns, but we're trying to consolidate this together for the financial statement purposes. And now when we do the reversals for the gross profit that was an intercompany transfer of inventory, now we also have the fact that there's going to be a tax expense, related to that, which we're basically going to have to reverse out as well. The difference in the timing and the tax expense recognition will cause the recording of deferred income taxes. So that's going to result in us having these deferred income taxes. So in other words, once again, we're going to do the consolidated worksheet, and consolidated financial statements, putting them together as if they were one, but they're being taxed as separate entities. And as they're taxed as separate entities, they're going to be taxed on income that could have been intercompany income that went from one company to the other company, and that's going to result in a tax expense that's going to be in the consolidation now, because it's going to be on the income statements that we're trying to consolidate for the financial statement purposes. So for financial statement purposes, we're going to be removing the intercompany transactions, the profit that went from one company to the other. But as we do so, we should also be removing, the tax effect that was included, because they were taxed on these items that is a deferred tax. And that difference, the difference in the timing and the tax expense recognized, will cause the recording of the deferred income taxes.